Guys, today we have on Annanay from QFEX. Very exciting new project. A little bit different in the sense that they're targeting maybe a bit more of the centralized exchange crossover model. And also, founder just came out of YC. I don't think I've ever had anybody come from YC, but extensive trading background. Annanay, welcome. Give us a bit of background, and then go ahead and maybe explain a bit about what you're doing now.
Yeah, thanks for having me, Gort. So my background is in high-frequency trading, like traditional high-frequency trading, not crypto. I started my career at Flow Traders, and I was one of the first guys on the crypto team there. Now it's like most of their P&L, I believe. Team's expanded a lot. And then I got headhunted in 2021 to Tower, where I worked on crypto and later traditional assets over there as well. So when I joined Tower, they were doing like pretty much half of all major PerpSex volume, spot as well, I would say. They've continued to do very, very well, along with like the other usual kind of incumbents. Plenty of interesting thing on that side as well. And now, indeed, I'm building QFEX. QFEX is kind of a project born out of inefficiencies I saw in traditional market structure that I got fixed by crypto and crypto markets, and not just regulatory inefficiencies, but tech inefficiencies, UX inefficiencies. And basically around this time last year, I was on holiday in Cambodia with my buddies, all of whom work in trading. One of them, my friend from back at Cambridge, worked at Citadel, and I was explaining to him how, this kind of crypto model of exchange has like massive use case, not just for like retail trading, but for institutional. And he got so bought into it that we ended up leaving our jobs and founding QFEX. So since kind of early this year, in February, we quit our jobs. We went through YC for a few months after that, raised a bunch of money, and now we're a few weeks away from our launch. So very exciting.
Like I said, I don't think I've ever, but maybe I haven't, I just don't know. But I don't recall having anybody on from YC before. And obviously, YC is probably the most vaunted kind of like incubator program. Why, out of curiosity, why go into something like YC? I mean, you come from like, quite a prestigious background. Your co-founders do as well. Like, you could easily probably go and raise directly from, I don't know, any of the biggest funds. Which I'm sure you will in the future. But just out of curiosity, like what is kind of like in your mind the what drives founders to kind of go into a program like this versus just going directly, especially when there's just a lot of money slushing around it in this space right now?
Yeah, really good point. So I guess there's like two answers to that. One is like, how close are you to the money? So, growing up here in London, both me and my co-founder, like we didn't know what venture was like before we started this whole thing, to be honest. Everyone here who does well out of college and then ends up getting a high paid job, it's very similar to like, I guess, East Coast to the US, but like here, the only well-paid jobs really are in like quant finance. And being in that circle, there's not a whole lot of VCs and a whole lot of obvious venture money flowing around. So YC was just super visible as a way for us to get funded and get started, I think. And the other thing is like, YC just has really good credibility and really good brand distribution. I would go out on a limb to say it could be the best VC in terms of kind of distribution or socials and all that kind of stuff that they're able to put behind you. And, kind of building a fintech, especially the way we're doing it, where we're not like trying to skirt regulation, but kind of leading into that and trying to get partnerships with kind of existing fintech providers, banks, and so on, getting them to take you seriously very early on. You need that kind of brand name VC.
Yeah.
If you look at it from a deal perspective, like I know people say YC, 125K, 7%, not a great deal. They really do boost your valuation in later rounds. Our seed round went at like a very high valuation, and I'm not sure that would be impossible without them. So overall, it was like good for us. It's very dependent on which partners you get as well. The experience is like very tailored depending on what your partners can do for you. We had Gary Tan, Tom Blomfield, who made Monzo, which is like massive fintech here in the UK, and then Pete Kuman, who were like absolutely fantastic, and we basically got the most out of YC that we could. So for us, like very, very positive experience. I think if you're building specifically for crypto and crypto only, may not be the best fit, but may not be a bad idea either. And I think it is true that the average quality of YC probably has gone down, like the median founder in YC has gone down. But if you look at like the top 5-10% in every batch, it's still like very, very, very strong. So for us, it was like kind of a no-brainer decision once we got the offer. We didn't try and max on the dilution. We just like went for it, and it was very helpful for us.
Yeah. Okay. So like go back a little bit. You were talking about, having done HFT originally in TradFi and then moving over to crypto. You talk about, you saw these inefficiencies and then talked to your friend who bought in, and that's the kind of the impetus for QFEX. What were those? What were the kind of the inefficiencies you were seeing at the time, and then maybe that leads a bit into how QFEX works?
Yeah, I mean, if you look at like traditional market structure, it's changed almost beyond recognition from like 6 years ago, something like that, right? And a lot of that is related to crypto. A lot of it is not. But I think crypto exchanges, because they've had a lot of very, very smart people work on them, and they've been able to work kind of outside the regulatory purview and been able to kind of design things from scratch, have been the leaders in innovation from that side. So specifically, that's kind of a high level argument, but specifically, exchanges now don't need to be in this like very intermediated model where, you have brokers that kind of act totally separately to the clearinghouse, which is like the accounting layer, the ledger layer, and then the exchange, which is like an order book that fulfills orders and matches orders on buyers and sellers who agree on a price. So historically, those things have been very separate, and that separation creates a lot of inefficiency that is not there in crypto, right? Like if you want to go trade on Binance or Hyperliquid or Aster or Lighter or OKX, you go on their front end, Aster, Lighter, Hyperliquid, Binance, they do all of the calculations of your margin utilization, your position. Everything is real time. The trades are matched real time. You have direct access to the order book. There's no payment for order flow. And by getting rid of that intermediation, what happens is, firstly, the exchange knows all the risk that's actually sitting on its books. So it knows like when people can blow up and when to give them leverage and when not to give them leverage. That's why you can do things like trade Bitcoin at 100x on most perpsexes and probably DEX as well, even though like if you want to trade S&P using futures on interactive brokers, like you only get up to 10x leverage, even though S&P is way less volatile. It's why you can have markets that are open 24/7. It's why you can have smoother UX. It's why you can have instant settlement. You can move your money in, move your money out real time. So those inefficiencies really are caused by, it's not we don't have the tech to do them anymore. Like crypto has shown us that we have the tech to do all this stuff, and we have highly available systems. It's more like regulators are scared to allow the change in because they don't want to move away from this market structure that have taken hundreds of years to develop. So, those concrete things, when I was working at Tower, they led to very concrete trading opportunities for us as high frequency traders that just take money away from retail and institutions who are trading on these exchanges. And that's really what I wanted to fix is like, hey, we have the solutions to, one small thing, like perps don't roll, right? How much money do you think has lost the industry from futures that roll? It's like in the billions of dollars every single year. So because we've fixed that problem of futures needing to roll in traditional markets, in crypto where we have perps, there's already billions of dollars we can add back into valuable businesses and retail pockets that won't be extracted from high frequency traders and market makers. So those problems, I didn't see anyone really making the push to fix them in TradFi, where like market size is way bigger, opportunity size way bigger, and that's what QFEX is about. Really, that's what we're trying to fix. Just to give you an idea of scale, like I think sum total of the crypto market daily, perps and spot probably trades around $100 billion a day in volume, right? Just S&P E-mini futures, so not even including the underlying stock trades $500 billion a day on one exchange, CME. So that gives you an idea of like the scale that things can operate at and the size of the opportunity that we take these innovations and move them into other markets.
Okay, so but like clarify it for us a little bit, because my understanding is QFEX is a centralized exchange. Like if you had to define it one way or another, you would call it a centralized exchange, right? And you're trying to take some of the primitives that we've found useful in crypto, perps, for example, put those into a centralized exchange format. What is kind of the design and who do you target here? So like, are you, going after the futures markets, right? Like with perps, I mean, I think the assumption is yes, but like explain also, like sort of how you view this going forward, and maybe a little bit about the design of QFEX in its current form.
Yeah, so QFEX has been designed with maximum fairness and maximum performance in mind. So those are like the two things we tried to optimize for. So by performance, what I mean is we want to be able to process like an institutional grade level of orders, which at institutional level speeds, right? Because those are the standards in TradFi. And if you want to have kind of institutions eventually trading on your platform after retail, you need to build your matching engine and your order book with those standards in mind. Otherwise, people won't use them. So what counts as good performance in DeFi can't necessarily hold up to CeFi, and that's just like physics, right? It's like you can't have this fully decentralized state machine that is able to like replicate state and move orders through in a state of like, I think CME can do like 1 every 3 microseconds. So we built all the tech in-house. All the tech is optimized for throughput and latency. And we've done that to give the best possible experience to all traders on the exchange, both kind of retail, institutional, and market maker. And if you kind of keep everyone happy, right? Like if the market makers are happy, they give tighter spreads, and ultimately retail get better execution, better order flow. Now, the fairness angle is, we wanted to make, I think a problem that exists in TradFi, which crypto has basically solved with like both decentralization and centralization, is that when you place your order into the order book, like you can see it there in this central state that everyone else has the same visibility on, right? I worked at Flow, I worked at Tower. We don't have special access. We couldn't see, who placed this order, what their data looks like, where they're from. It was still all anonymous to us. And if you, as a user, wanted to go connect to the API, you would have the same price feed that we would do as institutions, and anyone could go market make, anyone could trade via API, anyone could trade programmatically. And all of those things are missing in traditional markets, right? So if you go place an order on Robinhood, right, it's probably sold to Citadel Securities before it ever reaches the exchange. And that makes it impossible for you to know whether you got a good fill on your price, because you're now relying on Robinhood to report that statistic, and it's impossible to regulate that. And the other thing is it takes liquidity away from the order book, so then market makers don't have an incentive to market make on the order book, and that affects transaction costs for everyone, right? It's like Citadel Security. It's like any business, right? Like if somebody has a monopoly on a business, they can set whatever price they want. If there's perfect competition, like the end user gets the best price. So that's kind of the design of QFEX. It is centralized because of those performance reasons we mentioned. Obviously, like, if you go back like 5 years when I first started in crypto, like there was a big difference between decentralized and centralized. Now we're starting to see like hybrid models. People are doing kind of on-chain transaction reporting, but off-chain order books for performance. Some protocols like Hyperliquid obviously are like super decentralized, but they still retain a lot of the staking power for performance reasons and security reasons. So there's like a spectrum, right, of exchanges, and we are on the centralized side, but we've chosen those basically for performance reasons. And I think a lot of the kind of very hardcore DeFi native people might not realize how centralized a lot of their favorite dexes are.
Yeah. Do you think that's something like, okay, so now obviously probably the biggest narrative in the past 6 months to a year has been the emergence of Hyperliquid and perp dexes in general. So carrying on with that, do you think that long run Hyperliquid competes with something like QFEX in terms of performance? I mean, I think that the intuitive answer is no, but we are seeing the like unit, for example, now launching some, derivatives of equities and whatnot. So obviously the attempt is there. And like what sets QFEX apart in your mind? Like, is it performance truly? Like, do you think that Hyperliquid ever gets there? Do you think that that level of decentralization is ever commanded or desired by the user over, something much more centralized for other reasons? I mean, I think this has like been the point of contention in crypto for quite some time, right? Is like performance typically degrades with increasing decentralization, and now we're like, intertwining these ideas, and like what you said, a lot of these things are much more centralized than you'd expect. So I don't know, like what are your thoughts on that? Like in 5-10 years, obviously you're building with some design in mind. 5-10 years from now, where's Hyperliquid versus where's QFEX? Not necessarily specifically those, but like just the mentality of those, like the different directions.
Sure. I got it. So, I mean, I'll start with like what's possible and then what does a user want, right? So in terms of what's possible, it's just like a physical fact that the way decentralization works, right, is you have a bunch of different nodes running the same copy of the exchange, and they have to be in consensus with each other, right? The more you decentralize them, the more information you have to spread around the world, the longer it takes for those hops to happen, and the harder it is for things to be in consensus with each other, and the more time you waste basically trying to get into consensus, right? So it's just a fact of the world that if you have something like pretty centralized and something pretty decentralized, the centralized thing's always going to win on performance. I think the other thing to consider when we consider performance of exchanges is like liquidity. And what's been very interesting for like the perp dex narrative is a lot of these like very crypto native market makers like Wintermute and Selene, I job offers from both of them in 2021. they were much smaller back then. They really managed to grow in power as crypto in general has done well, and kind of VC money has flowed into crypto, and a lot of that has ended up on their balance sheet from projects. And because they're the ones who command most of the liquidity on places like Hyperliquid, smaller market makers like Symbolic that you may not have heard of, and like a lot of these guys, they have improved liquidity.
Which Symbolic? Are you talking about like SCP Symbolic or like the other Symbolic, like the... Sorry,
SCP.
Okay, yeah. Okay, go on.
SCP, yeah. So they've traditionally been the arbiter of liquidity on Hyperliquid and all these perp dexes, and they've managed to grow a lot in kind of the size of their operation, and that's why you see much better liquidity on Hyperliquid and so on right now. What's really missing are like the tier one kind of TradFi market makers, like if you look at how much money Wintermute makes and how much money Citadel Securities makes, like there's a factor of 10 off, right? Like Hudson River, Citadel Securities, Jump Trading, Tower, where I worked at, Jane Street. These guys are not going to be able to trade on no KYC exchanges.
Yeah.
Or in like a very, even if they are, it's going to be with very strong restrictions because they can't be seen to be in the flow of AML violations, right? They have money laundering requirements, and if everyone they trade against is a non, they can't ensure those requirements are met fully. And that's like another kind of, let's say, if Hyperliquid wants to get to SEX level liquidity, that's another barrier they're going to have to overcome, is like, how do they make the big tier one market makers with like huge institutional side balance sheets comfortable trading? Citadel doesn't really even trade crypto, or like barely trades crypto, right? Like if a SEX managed to convince Citadel to come and market make on them, they would like solve liquidity pretty much. So how do they level up on that side? I think those are two key issues for like DEX performance versus SEX performance. And then in terms of what the users want, I mean, it really depends who their users are. If you're on Hyperliquid, you have a bunch of DeFi native guys. Maybe they're not going to withdraw their wallets because they don't want to pay taxes. Maybe they don't want the source of funds to be found very easily. Those guys are they're not unhappy paying an extra couple of bips in fees or transaction costs or slippage. I don't think they really care, right? As long as they can move across chains very easily, and they can connect their wallet easily, and they have that smooth UX with their own KYC. We went the more centralized route because while we are targeting a lot of crypto people, there's a lot of guys like Robinhood people, or like my dad who trades like millions in TradFi volume every single year. He's not going to go out and get a Rabo wallet, or he's not going to go out and like know how to bridge his USDC from Arbitrum to Ethereum. So for us, those guys don't really mind the KYC, but the cleaner UX for them is like if they're able to deposit, let's say, their fiat very easily. Now we margin everything in crypto, everything's in stables because we think that's where the world's going, and we should be like at the forefront of that. But do we want to allow easy on ramp for people? I think yes, because that's where a lot of the TradFi trading and SEX trading retail are going to come from in the early days. So it's not really you're not really kind of comparing performance there. You're more comparing the user base and what the user base wants. I think one user base wants performance in different ways, and the other user base wants performance in other ways.
Yeah, I'm kind of curious. Like I've had this conversation with other people. A lot of the I think a lot of people think, and maybe I'm one of the few that push back on this, and maybe I'm wrong, so you can tell me if you think I'm wrong, but a lot of people think that Robinhood was successful because of zero fees. And I think that's certainly a part of it. But I've used Robinhood. I think it's I'm not like a big active user of Robinhood, but I've obviously used it. And I think it's a very clean UX. It has some elements of kind of like, it activates the neurons, but I understand why people use it, but I've often wondered, like, okay, so if Robinhood charged $1 or $2 or $3, like, people, and a lot of the pushback is, well, they solved, free trading because they could sell the order flow to Citadel. Like, that's great. And that is alluring, but I'm not so convinced that that's necessarily like the reason that Robinhood was successful, right? Like, it's certainly not the only reason, but I am curious, like, is zero fees something that is just like retail must have at this point? Like, you trade for free on Schwab, right? So they clearly compress margins across the board. But I'm just curious, like, was this really the selling point, or was it that Robinhood targeted like the GME guys who want to take on, and activate the neurons for them and get them on Wall Street bets?
Well, let me ask you this. Before Robinhood, how did you trade TradFi? Or did you?
I didn't, not really active trader, but I did use I used E-Trade, and then it became, or right, yeah, I used Scottrade, and then it became E-Trade. Now it's become Schwab, and I think it's, I'm not really like I'm not a trader, but I think
Yeah,
that they
absolutely.
were all fine, And before it was $0 fees, to trade a lot of the on these typical brokerages, it was like $8. You know what I mean? So it's
Uh-huh.
like, and again, if I guess if you're punting $50, yeah, $8 matters. But like any
Mhm.
real, like any actual trade, or let's say even like medium to long term investment, okay, I eat $8. It's not the end of the world, right?
Yeah, absolutely. And like you got to look at what retail want. Like, I mean, Kalshi have exorbitant fees, right? Like absolutely crazy
Yeah.
fees, like in the percentages, and people
Yeah.
still
Right.
like trade a ton of volume on Kalshi,
Yeah.
right? Like it's not really an issue. I think, especially if you're able to offer a lot of leverage, right? Like the fees don't really matter because
Right.
you're gonna make it back on the leverage anyway, on the user base you're targeting. I think zero fee is like a nice marketing gimmick, but
Right.
like it
Exactly.
would be disingenuous to the Robinhood guys and how good they are at customer acquisition to say that's what did it
Exactly.
for them, right? Like those guys are machines in like 100 other ways. They solved so many kind of psychological hacks that got people to trade more. They captured the meme stock craze like crazy. Even before they launched, like pre-product, they had a wait list in the millions, right?
Yeah.
And they were able to create that marketing hype around different social media platforms. Like that's what got them their users. And now there's all these rumors, like, oh, is payment for order flow a good thing? Like, I don't know doesn't matter. Like people still use it. That's the most important thing for retail. I think the zero fees thing is interesting. I think if they raise fees to like 5 bips on a trade,
Exactly.
five bips on $10,000 is $5. So like,
Right.
does anyone care? No, like no one cares about that.
But going back now, maybe like ideologically, people are like, hang on now, like the whole premise, you know what I mean? It'd be more like a
It's a new
potential
thing.
PR nightmare versus actually, like, I'm in agreement. Like it's like so negligible. But I did have one question. This is like a little bit more in the microstructure side. So like Lighter right now is charging zero fees to retail users, and one of the pushbacks I've gotten, the episode that will come out a bit before this one, I had this discussion with somebody. One of the kind of counter arguments I've heard that, okay, so yes, Robinhood can charge zero fees, but because they sell that order flow to Robinhood, and Robinhood can KYC every single one of their users and know it's not toxic, right? Or sharp flow. Lighter cannot. But what Lighter can do is charge API access. What I'm curious in your mind is, and I don't know how much this has to do necessarily with what you're building, but it's obviously in the same vein. Can you charge enough API access that it dissuades sharp flow from like picking off orders? Like, can they charge a fee high enough that you're not going to get toxic flow on the API side? Because right now with retail, like one of the, like, I guess it trades a bit slower, right? Like, so if you get API access, it's faster. It trades a bit slower. So I guess the idea is, well, you're charging zero fees to these people, but they can't, they won't be able to trade effectively. Not like how you did, for example, HFT style.
Yeah. So, I mean, look, your job as an exchange. So let's start from like basics here, right? So if your exchange just has people trading for very short-term profits, right, it's going to have zero volume. And to see that, you can just take a thought experiment, right? Like say I launch QFEX and the only 3 people trading on it day one are Hudson River, Jump, and Tower, right?
Very bad.
How much volume do you think there's going to be? It's going to be zero volume because those 3 firms I named do not lose money, right? If they lose money, they will turn off immediately. And then there's 2 people, and then it's just PvP. And one of them will start to lose money. They'll turn off, and there's one person. They're not trading against each other. So your job as an exchange is to like amalgamate people who want to trade for different reasons. And those reasons can be to make money in a high frequency setting. They can be to make money in a very long-term setting. They can be to not even make money, just hedge like external risks or business risks, right? And as a young exchange, your aim is to get a diverse ecosystem of all these sorts of people and get them to match against each other. That's a service you're providing for the world. And a lot of crypto exchanges kind of reach the, retail degen gamblers and market makers and just match them against each other. That's the only service.
Yeah.
Now, when it comes to structuring fees to make that alluring, right? The typical reasoning goes, HFTs, we need them to provide liquidity, so people trade, so we'll give them very low fees, and we'll give retail high fees because, we don't care. And Kalshi is like a good example of that. They charge retail ridiculous fees, people still trade. They charge market makers very low fees or even negative fees. They pay some market makers, some markets. Lighter, I think, has moved the model away to let's just make it zero fees and actually charge the HFTs to charge the people who are trying to provide liquidity. for access. I think that does two things. One is that they think that by having zero fees for retail, they'll attract so much retail that market makers will make so much money off them that they're actually willing to pay a cut of those profits back to Lighter, which is an innovation. Exchanges don't usually think that way. The whole thing with sharp flow is like, I don't think it's like very effective to police that with fees. Typically, the way exchanges do that is they have some kind of speed bump for orders that take liquidity, or Hyperliquid does that very well. Hyperliquid actually took it off a previous FX exchange called EBS, where they basically take a load of orders and then all the cancels get prioritized first. If you want to cancel your orders, they will get cancels first, and then taking orders will hit the book. I think that model also works very well. We have a speed bump at QFEX, right, to prevent the exact same thing.
Interesting.
I think you want to prevent latency arbitrage because it basically it kills off the smaller market makers and decreases competition in market making. And competition market making is what ultimately gives good spreads to retail. So Lighter are doing it in kind of like a hybrid crypto exchange / payment for order flow way, where they're saying, you can come market make, but you're going to have to pay us some of the profits. That's interesting. I think it works well with what their points model is going to be eventually as well, which is that people on API are going to be able to earn more points, so they should pay for those points as well. Lots of different ways of skinning a cat, I think.
Let me take a moment to talk to you about Ellipsis Labs, a team I've known for a while building some of the most interesting products in the space. The Ellipsis team is one of the few that I can consistently point to and say, these guys really know what they're doing. They're backed by Paradigm, Electric Capital, and Han Ventures. The founders, Eugene and Jerry, have experience at Citadel, Jane Street, and the Solana core team. Since launching their order book DEX, Phoenix, they've done over $80 billion in trading volume by making on-chain order books competitive with centralized exchanges. They are also the team behind Gavel and SolFi. I would consider them the foremost experts in crypto market microstructure. The best part is Ellipsis is hiring for New York-based engineers. Work with a small, focused team who are results-driven, collaborative, and use a modern stack. If you're an engineer who wants to work on infrastructure that's already proving itself in the market, go to ellipsislabs.xyz. Okay, now back to the show. You were talking about like how, I'm switching subjects a bit, but you were talking about how the intermediaries that we've used for the past 50 plus years, but maybe more specifically, once electronic trading became the main kind of way to access. You were talking about how like there was these intermediaries, like, Robinhood, for example, is a brokerage and people don't know that they're not like interacting directly with like some order book that may be 2 or 3 hops away. In terms of the QFEX model, so walk me through this. It's, in your mind, retail accessing directly in the same way that we're accessing Hyperliquid, Lighter, Aster, so on and so forth, except it's just in the SEX way. Is this correct? So like in your mind going forward, there's going to be a lot more disintermediation of these actors kind of along the supply chain that have been scraping along the way.
Yeah, absolutely. So I mean, let me talk about disintermediation. This is like talk of the town in our office right now. The whole point of intermediation was like in the past in the US, right? These roles of like the exchange was like literally a floor, right? It was like a place in Chicago where people screamed at each other. The clearing firms were basically like accounting firms that represented people who would go and scream at each other, the traders. And the brokerages were like very different businesses. There was like an office like in downtown of some like 3-horse town where like people would come and submit orders for tickets and they would get sent off to the exchange. Now all of them are just SaaS businesses, right? So exchanges is just an order book that runs on AWS. A clearinghouse is just like an accounting ledger that runs on AWS, and a brokerage is just a website that's hosted on AWS. So it's the same thing, and we're at the stage in tech where we can combine all those 3 things. What's happening though is in the legislation, they're still treated as 3 different things. The Commodities Exchange Act is like super old. It's way over 50 years old. And they treat each of those different parts of what we now consider an exchange in the crypto world as separate businesses with separate requirements. And basically what this does is it creates hops between the different layers that reduce capital efficiency in a way that makes it very hard for them to offer high leverage. Now, one very concrete way that they do that is the CFTC for US exchanges says if you offer leverage, you have to trade via what's called an FCM, a futures commission merchant, like Robinhood. It's basically what we call a broker. Like Robinhood is a broker, it's a futures commission merchant. And if you lose money and your account goes into negative, right, what would happen on a crypto exchange is the exchange would try and liquidate you on order book, right? Otherwise, your account would go into some vault. And if it goes into, by the time it goes into some vault, your account balance is negative. There's some auto deleveraging. It takes money out of the vault, close your position against someone who's long, and that's how liquidations work. Now, that process is very good for people who want to take a lot of leverage. They don't mind their account going to zero because they're willing to take big bets and they want big upside. And they don't really care a lot about their position potentially being pruned sometimes, or being taken to zero if they get liquidated, because that's just like the game they're in, right? Like they're playing for leverage, they're playing for big speculation. The way exchanges evolve in the US is like actually the complete opposite way of thinking. So the way the CFTC thinks is the most important thing to preserve for the end user is that their position should never change, right? So they can make a ton of money, they can lose a ton of money, they can go really negative. They don't ever want their position to change because exchanges were originally made for farmers in the Midwest to go and like hedge their harvest, right? So they were like, if this farmer is going to harvest like 10,000 bushels of wheat or whatever, like a billion lean hogs or whatever, like, and he's hedged that with futures, that amount of hedges cannot change because they have to go deliver that wheat or they have to go deliver those lean hogs basically at a market at some point in time. So as a result, like the way market structures evolve in the US is like, if you go on Robinhood and your account goes really negative, Robinhood is on the hook for that money, right? So they have to pay the money out of their own balance sheet and make your account whole, right? How do Robinhood liquidate you? The only way they can really liquidate you is on the order book, right? So they have to submit your orders to the order book and they have to find someone else to take the other side of those books. Even if the market liquidity dries to zero, they can't auto deleverage you. It's called tear-ups in the traditional world. They can't do tear-ups or auto deleveraging against other participants until Robinhood as a firm goes bankrupt, right? So Robinhood is like a massive company. They're not allowed to auto deleverage one contract of their users, even if your account goes to like negative infinity, until they go bankrupt, right? And even then what happens is they go tell the clearinghouse, like, we've gone bankrupt. You now need to cover our losses with your own money. And when the clearinghouse goes bankrupt, that's when they start like tearing up contracts against each other. Like, okay, we have to auto deleverage now. There's like no other option. Because, all the positions have to sum to zero and there can't be any bad debt in the system. So what disintermediation allows is this like crypto model where we say, we're not going to make ADL like the very like last thing in the step. We're not going to allow like multiple billion-dollar companies to go bankrupt before we start doing ADL. Like if there's market volatility, ADL happens and like people are fine with this every now and then because most people are taking short-term positions. And that's where market structures evolve to at the moment. The vast majority of futures trading in the US, even from institutions, is mostly speculative. There's very few of the farmers that are left. Very few contracts on the CME that really cater to these farmers. And what's very interesting is that, you may know about this, but like FTX actually tried to make the first unintermediated US regulated exchange way back in 2021, 2022.
Like, was it like IX or something? Or are you talking about it's like FTX tried to do it?
This is literally FTX. So FTX bought an exchange called LedgerX in the US, and then they applied to the CFTC to change the rules under which LedgerX operates in order to allow this unintermediated leverage trading. And if you read all the submissions to the CFTC, they're basically describing how like a typical crypto exchange waterfall works. They were like, we're going to have auto deleveraging. If there's bad debt in the system, we take money off people who are winning. If shit hits the fan, like people get closed out of positions they didn't want to get closed out of, but that's fine. People signed up for that. The advantages are, the vast majority of market participants now, and I'm not just talking retail anymore either, even institutional market participants are playing for leverage and they are playing for speculative profits. And this is an exchange made for people like that, right?
Yeah.
And if you have rules that are like, Robinhood as a company has to go bankrupt before you start doing ADL, those exchanges are never going to be able to offer that much leverage. And that's why we've seen way higher leverages in offshore exchanges. And, someone needs to go to the CFTC and basically make that point to them is like, hey, there's all this business going on offshore in the outside the US. We need to bring in a crypto style clearing system, crypto style leverage system, because this is what the people want, right? Like, and if you don't do it, they're going to do it offshore. And then that's even worse because now you don't have oversight. Yeah, they are doing it offshore. Exactly.
Going off this point, just because 1010 is not too long ago, what did you think of how, like, did you have any unique insights with regards to how 1010 went down? ADL also, on that vein with ADL, one interesting aspect of this, as I'm sure that you were paying close attention to, was that there were, unbeknownst maybe to some traders, trading firms, there were some people who were less likely to be deleveraged because of some deals they made. And it seemed like, well, from what I could kind of infer, the very large players knew this. And then retail, like, is aware that or like some of the smaller retail traders know that they can be evaporated at any time. But some of the kind of like middling tier, or I would say like middle market trading firms, maybe did not have these special agreements and were pretty upset and may have been blown out. Talk to me about like, what do you think of this in general, right? Like there may be some participants in this massive, like sort of in theory, balanced, long, short, bucket of leverage that kind of have some preferential treatment. And then when something very, very bad happens, like this isn't such a great model, like, or any other insights you have on 1010, but maybe that one was kind of interesting to me.
I will say the thing about market makers having preferential treatment, there's like a spectrum of preferential treatment that you can give market makers. It's not as black and white of like, if you give market makers some preferential treatment, like that is necessarily harmful to everyone else on the platform, because some incentives, like you just need to give them, like if you give market makers negative fees, that's just the exchange gives preferential treatment. So the exchange is losing money there, but we're doing it to give better fees to the users. I think the type of preferential treatment you don't want to give is like telling market makers they can't be auto liquidated or ADLs, because what that does is it can put the exchange in a situation where a market maker has lost like a shit ton of money, and the users have basically made a shit ton of money, or some other users made a shit ton of money. They can't now close out the market maker, so there's bad debt in the system, and then the user tries to withdraw all their winnings and they're not able to. So what's effectively happened there is like the exchange is on the hook for the bad debt of the market maker that they haven't deleveraged, and they need to top that up from their own balance sheet, but that can bankrupt the exchange itself. So that's a very rickety system, and that's we would never do that to any of our market makers. But the way things went down, like it was like a macro-driven move, right? Like a lot of people in crypto forget that like macro happens, and like Trump is there, and the stocks fell a ton that day as well. Obviously, there's all kinds of inbuilt systematic reasons why crypto moves are just like technically amplified or macro moves are like amplified in crypto. Use of leverage, thin liquidity, like market makers are generally, as I said, not tier one guys who are capable of quoting in any situation. Citadel Securities isn't there. It's generally Wintermute, Selene, these types of people, good, but not capable of like handling all situations. And then once liquidity dries, obviously it's just like a panic sell. So I don't think there was anything super special from that side, other than just a big move. I think the stuff around people, what was it, Backpack, where like people deposited money into like their negative balance accounts, and Backpack just stole it. I think that's very disingenuous.
Well, I think, so I know what you're talking about. I'm not my understanding is that came from people who were like KYC'd and properly trading on their SEC side. So maybe it's a bit different, but I think if you have only like interacted with crypto protocols, right? And then you go and you deposit and they just zero it. Yeah, that would be like very jarring. Like, hang on a second. I thought, right? Because I think a lot of people's minds like, oh, okay, I have bad debt. I'm just never going to use that again. Obviously, like just move on, right, to something else. But I think there was some miscommunication, but I'm not on either side. But that's not ideal, right?
Yeah, that's not ideal. I think things need to be clear, and people should issue a statement. Otherwise, you just piss everyone off, right? So those things are not ideal. Otherwise, it's like, ADO happens. It's like the game you play. You get 100x leverage on Bitcoin, which is way more volatile than S&P, where you only get 10x leverage. There's like a price you pay for that. As long as it's like clearly in the docs or in the user agreement, like no one has anything to complain about. I think it's just rules of the game you play. If you don't like it, like go play a different game. I think that's it. I know Matt Levine has a very interesting series. I don't know if you read him, but he has like a very interesting series of articles and like letters he wrote in his column Money Stuff, where he was like, I can see the case for like different types of exchanges happening with different rules, and there's not one set of rules that every market needs to abide by, right? And being in crypto, or even a lot of people in TradFi forget that. There's markets out there which don't have price time priority. They have pro rata priority. They work pretty well. There's even arguments to say that if you allow insider trading on some markets, that's also fine, because people will figure out people who have insider information will make the market efficient very, very quickly, and then basically that's the most efficient information aggregation mechanism you can have out there. So it's as long as the rules are clear, like it's these are the rules you're playing by, right? So it's
I think
no reason to complain.
A lot of Matt Levine's, I think, points, which are fair, is that there should be these markets that exist where if you want to participate in them, you can, but you need to know there's no recourse, right? And like I think he made this joke about you get slapped in the face or something and told like you're going to lose all your money. If you still choose to lose all your money, so be it. I think this is just like it's difficult in crypto because people do want to integrate this into the traditional financial system. They want their rules to apply to them when they want and not when they want. So like then it just gets into this very complicated. So in any case, okay, so let's talk like a little bit about more with QFEX. And this is a question I've now asked a number of people, and I'm always interested in the answer, which is this product Perps is like taken off in crypto. And where do you see this being most useful in efficient capital markets going forward, right? And like, so there's already futures contracts, there's all sorts of derivatives, there's also, CFDs, which are less common in the United States, but are traded, in a lot of volume elsewhere. Like, where do you see Perps really being like, having like true product market fit? And maybe, right, okay, so we know degenerate gambling, but like what else, right? Like surely there's hedging.
Let me start it off with like, Perps are literally just like an exchange trade version of swaps. You've seen Big Short. There's like that scene where they try and get an ISDA agreement to trade swaps over the counter with banks. Like people have been trading Perps, basically instruments that track the price of some underlier that you can trade for leverage, where you just swap the implied P&L every day with some counterparty with banks for like centuries. Oh, maybe not centuries, but like decades for sure. Right. So Perps are just an exchange trade version of that. The underlying market for swaps that trade on OTC via banks, on like pseudo electronic facilities called SEFs, swap execution facilities in the US, that's massive and has been massive for like a while. Perps are just like a standardized fungible contract that trades on a central limit order book, which has the greatest possible benefit for liquidity because everyone knows like these are the contract specs. This is what you trade on. Everyone can kind of pool all their liquidity and balance sheet that they want to use to provide liquidity into like one order book, and then everyone gets the most benefit, right? Like typical marketplace effect. So the answer really is like, firstly, do people want to trade things with leverage? The answer is yes. I hope that's like easily apparent. Like businesses have business risks that they want to hedge. Oil companies want to sell oil futures to sell oil before it's drilled. Gold companies want to do the same for gold. Companies need to buy and sell their own shares of stocks. Investors want to invest their money into the stock market, whatever. That has like real product market fit, and that's been going on for a while. Now, why do we want Perps, or why do people trade swaps over the counter when you can trade futures? The real answer is like, why trade futures, right? Like futures expire at really random times, and no one really wants them to. Why is that? Well, futures were made, it goes back to the farmers, and Chicago, CME was originally made for Chicago farmers and out in the Midwest, mostly listing commodity crops. Futures were made so that there was like a specific date that farmers could harvest all their crop and deliver them on that date, right? And then the CME thought, hey, bright idea, why don't we just put these on equities? Why don't we put these on like FX pairs, like random things that don't really have delivery times?
Yeah.
That expiry creates like a lot of friction. So, back at Tower, and even at Flow, we would make a lot of money trading around rolls of these futures. By rolls, I mean, the day before expiring, the day after expiring, is people are forced to liquidate their position in the expiring future and then buy the next one. The market loss to high frequency firms and market makers from rolling, which is all completely unnecessary, is like in the billions of dollars every single year. So why do we give up those billions of dollars? Why do we add up all the operational risk and all the headache? There's all these famous stories of people getting delivered their onion futures, or they forgot to sell out of their coal position, and then they suddenly get delivered like a load of coal at their doorsteps. Why do we still tolerate that? And the answer is just like fix it with Perps, right? Like it's a much bigger problem than people realize on the institutional side, and we can just fix it with this more capital efficient, more cost efficient structure.
So do you think that, quick question, you were talking about delivery, right? And that was like one of the, Bitcoin is like quite easily deliverable. So, it's like that is a difference versus lean hogs. Do you think something like oil futures ultimately converge around perps as well? Where in some scenarios, right, it very much is predicated on ultimately delivering this somewhere in Texas or whatever the supply chain is. But is that
absolutely. I mean, if you look at if you look at like there's always going to be a use case for those farmers and the oil futures and stuff like that. If you look at like total volumes, like a very small percentage of the volume that's traded is actually traded by these guys, and that will continue for sure. Like like the futures market still serve a need for soy farmers to deliver their soybeans. But when I was trading soybeans in my last job, I was not like the harvest was not in the back of my mind, right?
You
and
never
I
saw
did a
the
lot more
soybeans.
volume. I never saw the soybeans. No, they would always the position would mysteriously turn to zero before the futures expired. So and I guarantee you, I was doing more volume than any single soy farmer out in the Midwest. That's like my personal guarantee to you.
And then so then that makes sense. Options, right? Like zero DTs on Robinhood and stuff. I think it's now. I was seeing yesterday, and I saw this on Twitter, so it could be a completely ChatGPT hallucination. But I think I saw like 60% of Robinhood volume or something is now 0 days. Perps seem like so much obviously better, but maybe that's because I've like degenerately gambling on perps and crypto, right? And I don't really do that on Robinhood. Do you think this is just like obviously gonna kind of take a massive portion of that going forward?
The reason they invented 0 days was to simulate perps, right? So like there's this regulatory issue in the US of like if you want to list futures or perps on single name equities, you need to be licensed by both the SEC and the CFTC, which is like very annoying to get both. And there's one exchange that did like a long time ago, one Chicago. No one's tried it since. If you want to do options, you don't have to do all of that hassle. And that's why options have been listed. They're like the main retail product that people use in the US on Robinhood, like through regulated brokers to degen on equities. Like degeneracy is not going to stop, right? Like degeneracy is always going to be there. And then people thought, hey, like people aren't really trading these for the long-term Greeks and like the gamma and like the rho and the vega and the theta and stuff. So why don't we just make an option that has the smallest amount of like long-term Greeks as possible, and it just tries to track the underlying like a delta one and offers leverage in like a simulated way. That's where 0 days came from. The natural progression to that obviously is then just to have perps on equities. That's what FTX tried to do. It's what somebody's going to do in the future. It's what we're starting off with offshore, obviously. I think that's the natural progression. There's a lot of advantages to perps, right? It's like much simpler, much easier to see where your P&L is. You don't have all these gamma risks. You don't have liquidity fragmentation across multiple order books. You don't have multiple strikes that basically all offer the same product, and then you don't know where to execute. So you don't know where your price slippage is going to be least. Seems like the natural solution. I actually have a friend who told me that BlackRock had their like management offsite a couple of weeks ago, and one of the presentations there was from someone who like told the entire senior management team at BlackRock how like perps are like the end state of finance, right? It's like if you want to trade or speculate or hedge the price of something, this is like the most efficient way to do it, right? Like there's leverage, there's you just have to trade once to get in, once to get out. It's super clean, super simple to understand, very intuitive. There's like a free market way that they track the price of the underlier that doesn't require any external intervention. It's pure like Adam Smith freehand stuff. Very, very cool.
Yeah. How do you differentiate like some of the models with Hyperliquid? I think the premise is bringing liquidity on chain, right? Like, and that's sort of one of their selling points. Then you have others that are, not attempting so much to bring the actual liquidity and more just kind of like a generic price feed. And it seems like a lot of people are kind of targeting this differently. Obviously, you're going with a centralized exchange model, so like the order book being liquidity on chain, I assume. But like, how do you view these kind of like right now? There all these different. Remember Mirror? Sorry, this is like just thought it was like Mirror was like there's like another hilarious way to do this. But what is kind of like the most efficient in your mind? And I will also give you two questions at once. Is this, in your view, like a winner take all thing, or no? Like, is the place with the most liquidity going to have sort of like outsized returns to scale, or is there going to be a lot of fragmentation going forward, even if it's around sort of the same product, which is maybe in this case perps?
Yeah, so I don't think it's winner takes all. And it goes back to a point that I raised earlier, which is you have to think very carefully about what the users want and what risk trade-off they're making, particularly with regards to leverage versus liquidation and how solid their positions are in your venue, right? So on the one hand, if you go trade on CME via like a well-known established broker in the US, according to history, it's never happened. Like tear-ups have never happened in the US before, right? So if you're like a large institutional hedger, let's say, of some commodities contract, and you want to go trade on CME futures using some broker that's out there, you pretty much know your position is going to be safe. You don't necessarily care about being super capital efficient. You're definitely not trying to make P&L. You're probably going to lose P&L because you're transacting in a market where you don't have any particular edge. You're just trying to hedge some other risk. And then, all the way down to, there's a lot of perp dexes out there offering like 100, 200, 250x on Bitcoin, right? And it's like, they're basically doing it to try and compete on leverage. They want to attract people who are just going to place like a massive position, right? They don't mind getting auto deleveraged. Basically, there's more than one axis around which you can play the game. And there are different exchange models that can occur depending on, even for a particular symbol, a particular asset, depending on how much leverage people want and what rules they want to play by.
Yeah.
Right. So we see, in regulated markets, typically where the regulator has very strong opinions on how markets should be, you typically, just for every symbol, there's like one exchange that has all the liquidity, right? Like if you want to trade S&P, that's CME. If you want to trade NASDAQ, that's CME. For oil, there's two types of oil. There's WTI from Texas, and there's Brent crude from the North Sea, close to where I am, right? One of them trades on CME, one of them trades on ICE. TTF, which is Dutch natural gas, trades on ICE. There's only one exchange, right? In crypto, where there's no regulation, there's lots of different degrees of freedom how you can design your risk engine, how you can design your liquidation engine, how you can design your order book, how you design the UX. And regulators aren't imposing that necessarily. There's loads of different sectors, loads of different dexes, each of which cater to a slightly different use case. And they're not necessarily targeting the same customers. So they can definitely exist side by side. When we build QFEX, right, like we're not going out there, and I'm not knocking on CME's door and saying, hey, I'm gonna steal your customers on day one. Because their customers are like, they trade through brokers that give them cross-margining benefits across multiple exchanges, right? Like I can't offer that on day one. So we know who we're targeting, they know who they're targeting, and those ICPs are very different. Sorry, what was it? That was the second question. What was the first question?
The first question, well, I mean, you don't have to go too deep into it. I'm just kind of, there's a lot of different models right now with like how to structure perps. And I don't know, are there any, maybe one question, is there any that you think like obviously don't work?
You mean like clubs and AMMs and all this kind of stuff?
Yeah, I'm just thinking like, for example, do you know how Ostium works?
Yeah, I know how Ostium works.
It's a little bit different, right? There's like this pool model, and I think that,
I mean, Ostium is basically an AMM with like some accounting trickery to kind of make it a pool, but in reality, it's just an AMM. I had a thread about this, not about Ostium in particular, but about like AMMs versus like clubs, right? And what it really boils down to is like market making and providing liquidity is like a really, really hard job, right? Yeah. And a lot of people in crypto don't understand that, but every time you market make, every time you put two-way prices into the market for other people to trade against, you're basically selling options for people to transact against you, and you expose yourself up to adverse selection because you only trade when someone else wants to trade, right? Yeah. If you ask me to make a market on something, right, and I give a two-way price on it, right, either you know the price and you know my price is like below that and above that and you're not going to trade, or you don't know the price, you're not going to trade, or you think you have edge on me and you trade against me, right? So I'm always exposed to that. And as a result, market making is inherently a very difficult job that needs constant research, constant refinement. Citadel Securities hires like thousands of people, same with Jane Street, same with SIG. They're not doing nothing all day, right? They are going out and basically playing this competitive game against other market makers, and market making games have to be competitive because that's how they compete to give the best possible transaction costs and best possible spreads to the user. And any kind of automated market making model is basically subject to doom.
Yeah.
The only way a price on like a pure AMM model, like like early Uniswap, they had these like curve models, right? Like where you have constant automated market makers. How do their prices stay in line with the rest of the market? Well, someone just arbs them against the rest of the market, right? It's like
SCP arbs them.
if Uniswap's prices or an AMM price is like here and the market moves down, somebody will arb it. And that arb is just ultimately money lost by people who lend money to the protocol for the AMM pool. And no matter how much trickery and stuff you put around there, you can have shared layers, you can have this, you can have that. The only edge that a protocol or an exchange's kind of internal vault or market making pool or liquidation pool, whatever they want to call it, has is that it can take liquidation orders from other participants, and it's generally positive EV to take them. Then it has to hedge them out. Anything other than that, just you have to build a market making firm in that case, or otherwise somebody else will out research your market making strategy and start beating you, and then you'll leave. So based on that, I think it's pretty. I would say it's pretty well established that like central limit order books like the way forward.
I think initially, I think initially the like, and this is something that, I kind of objected to early on as well, but it seems people understand now. But I think initially the idea with AMs, at least the first iterations, was like anybody can make markets, but then it shifted to, well, this is how you provide liquidity for long tail assets, right? Like it was initially, we can all be market makers, and then it's, well, actually the way you need to launch long tail assets is with some type of AMM. And it's like, okay, sure, like some meme coin, if where people are pretty price insensitive, that's fine. But like whether or not this is like a massive financial unlock going forward, to be determined. It's interesting. And then you get like the mechanism designers who are like, well, if you think about it, like order books really, like pricing an order book really is similar to a curve. And it's like, okay, what?
No,
like what?
Those guys have never worked in HFT, man. Like no one in crypto has just like worked for a real trading firm. That's the problem. That's why I respect Jeff so much. Like he worked at HRT. There's like a real dearth of founders. I mean, like at Tower, like no one really, unless you were trading. I didn't know what Hyperliquid was until years and years into trading, like on Binance and OKX and all these things at Tower. Like people at these firms they're not super crypto native,
right?
And they're not aware of a lot of like the dumb shit that's going on.
Yeah.
And that's what I love about crypto, right? It's like everyone gets a chance to have their say, and 99% of the shit that's created is like really, really stupid and made by people who have no idea what they're doing and probably shouldn't even be alive. And then 1% of the stuff is amazing, and that's innovation, right? That's what causes progress to move forward. It's like you have an AMM, okay, it's like a pool, fine. Okay, what are the fair price the thing moves up? If there's no concept of fair price, it's a meme coin.
Right,
whatever,
exactly.
That's fine. But as a founder, why are you creating an exchange for coins that have $1,000 of liquidity? Like,
I think
why
that's
are you structured for that?
Yeah, that is like kind of what I mean. Not this is really a topic of conversation anymore because I think most people have concluded similar to yourself. But that was one thing that I kind of was always like, okay, well, these people are like, these are useful for meme coins, but they didn't necessarily consider the idea that they were only useful for meme coins.
Yeah.
You know what I mean? And like that was it's like, oh, we can extend this to XYZ markets. So I'm like, well, you hit some higher bound of like market cap and it just becomes functionally useless, right? Nobody's going to make markets for this stuff. But whatever. It's like, okay, cool.
Yeah. It's basically like, if you want a mental model to think about it, it's like an AMM is kind of like it's like a central limit order book where the market makers have no option to cancel. Like anytime the underlying price moves, they can't cancel their orders. They just have to wait to get picked off, and then the picking off moves the price back in line. And now they've lost money because they've been picked off on a price move. And then you add the ability for them to cancel and like, hey, you reinvented the central limit order book. Good for you.
Yeah. Okay, the last thing I wanted to ask you about, it's a sort of adjacent conversation, but you had this long thread that kind of showed the difference between Kalshi and Polymarket. I think you were alluding to before, like the quite high fees on Kalshi, but it's interesting, obviously, because Polymarket uses like a true order book bundle. Like, can you just like walk me through that? Is like I'll maybe link in the show notes, but it's like really interesting. Thoughts on prediction markets there?
Yeah, look, I mean, my overall thoughts on prediction markets are like, what a lot of you viewers might not know is like prediction markets are like not new. We had a company called Betfair, or we still have a company called Betfair, it's still massive in the UK. Betfair started in like 2000. It was like a unicorn back in like 2005 or 6 or something when being a unicorn actually meant something. Then it got acquired in like 2015 by a major sportsbook. Pretty much followed the exact same path that prediction markets in the US are following. Like they try and list everything. There's no liquidity on anything.
Yeah.
Sports and elections have liquidity. People just use prediction markets, trade that. And then eventually, I know that all of the major sports books in the US are trying to launch their own prediction market. And those guys are machines at customer acquisition, and eventually they will just have it in their ecosystem, right? So DraftKings just bought Railbird, famously. Great acquisition, by the way. YC company, 3 years, got a license, zero revenue, acquired 120 million. Good for them. I know for a fact that Fanatics are incubating their own sportsbook. They're going to partner with a DCM. There's a bunch of other ones, but anyone you can imagine is basically trying to get into the prediction markets game. That's where I see the end state of it. It is probably more. It's probably better for retail than sports books are, because it's just like an exchange-ified version of an otherwise OTC market, which is just odds on various sports events. A lot of the other claims about information aggregation, all this stuff is like, well, I mean, there's no liquidity on a lot of those contracts, right? It's like
there's nothing to glean from that.
Yeah, exactly. Like it goes back to what I said about if you have an exchange where the only people who are trading for the same short-term profit, like that exchange is going to die very quickly. That market's going to die very quickly because basically the people who don't make money are just going to turn off trading, and then there's just like one trader left.
Yeah.
So, and also nobody can price these Taylor Swift like color of dildo like
exactly.
whatever contracts, like
Yeah,
so,
I think that's like one of the big. This is probably all these things. Like such is the case with basically all technology, where it's super hyped and people give all these completely outlandish reasons for it to be useful, and then it kind of centers somewhere in the middle. It's not so clear. I tend to agree, though. It's not so clear that there are that many events that actually provide a tremendous amount of information to the public. Elections are interesting, and I think a lot of it is a lot of the ones that are interesting are kind of predicated around we as a society trust that it's pretty fair. And once it becomes not pretty fair, it becomes increasingly useless unless, like you were saying, it is for the sole purpose of bringing inside information to light. And probably a very, very large portion of these markets in some capacity are designed to bring insider information to light. We've seen this time and time again now. I think what mostly you come at this from a very like experienced background, but what I think a lot of people in crypto especially don't understand is that if there's a market for when Taylor Swift is going to get married or whatever, get engaged to, is like SIG and Citadel and HRT just are not going to engage. And so when there's not much engagement, there's not much liquidity, and there's not much to really glean from those events. But that's something that seems that we have to learn, and we're still in the process of learning. You see people citing right now, you'll see VCs citing prediction markets, and there's $20,000 of volume. And it's like, dude, what do you think that this brings to light for the greater human good? You know what I mean? There's nothing to take away from that.
I mean, that says a lot about those VCs, I would say. I know you had Chang on the show before as well, and like he has like a lot of very strong opinions about VCs. Yeah. Chang actually gave me a list. He was like, these are the only 3 crypto VCs you should ever speak to. And I pretty much abide by that.
Talk to Rajiv. He's just one of the homies.
Yeah, Rajiv is on the list, by the way. Rajiv, if you're listening, you're on the list. Don't worry about it. I do talk to Rajiv like almost every day.
Me too. He's like one of the only ones I talk to every day.
Yeah. I think you should keep it that way. I mean, the thread, I mean, going back to the thread I wrote, it was basically, the original question was like, it's basically was highlighting a little piece about tick sizes and kind of showing to light, a lot of people talk about Polymarket zero fees, Kalshi's high fees. Yeah. There's this other hidden aspect to it, which is that having a market with really, really fat tick sizes, and, to give you an idea, like most equity or futures markets or even crypto markets out there, the tick size, which is like the minimum price increment you can change your order by, is like around the order of like 1 basis point, 1 to 5 basis points is like considered a good tick size. Kalshi's is like 1 cent on 100 cents. It's like 1%, so much, much higher. And it was just illustrating a couple of reasons why that's not great for a lot of people, and particularly how Kalshi themselves can like use that to monetize. The example I gave was like, let's say there's a market which is like, has like a fair price of like 50.55. On Polymarket, it's listed with a 0.1 cent tick size, and on Kalshi, it's a 1 cent tick size. On Kalshi, the market would just be 50 at 51. That would be the bid offer quote. And on Polymarket, it would be 50.5, 50.6. Now, a market maker on Polymarket would make 0.1 cents if they manage to buy and sell without the price moving. It's like a round trip bid offer spread, which is like a good proxy for market maker P&L. On Kalshi, it would be 10 times higher. It would be like 1 cent. And on most markets, not including the sports markets, to be fair, which does have most of the volume, but on most markets, Kalshi Trade are the only market maker on those markets. So, as well as making money on fees, which Kalshi Exchange does, the market maker also kind of makes it easy for themselves to market make. They don't need very accurate pricing, and they can just round trip 10x the fees that they would be able to if they were trading on Polymarket, which is ultimately money lost from retail back into the pockets of Kalshi or SIG or whoever's trading on these exchanges. And in terms of their whole narrative of these information aggregation mechanisms, it just reduces the resolution at which you can aggregate information at. Right? If you have a 1 cent tick size market, you can only be accurate to the nearest kind of 1%. Right? Whereas if you reduce the tick size, you allow the market to be more accurate, and you advantage people who do a better job at price prediction. Because they're able to quote tighter and they have a lower error around the values which they're willing to quote around. They're willing to quote tighter and pick up the retail flow. Whereas if you don't know what you're doing, then you can trade on equal terms, basically on the Kalshi markets.
So one thing that I'm curious about, you would know better than I do. You were talking so going back to originally talking about perps and Hyperliquid, there's a lot of large market makers that simply cannot engage because they have to have KYC AML laws. Can big sports market makers make on Polymarket when it is decentralized?
If they don't KYC, I imagine no. Right, that's the issue. It's the KYC part. It's not perps. It's not. It's not prediction market. It's like basically they need to be able to answer to the regulator with some certainty. Like, I did not just help a Russian oil billionaire with some sketchy money move their money from one account to another account, and therefore loosen the trail of their origin of funds. And if they can't do that, then it's tough. They can't trade there, and they're never going to risk that because they're making so much money trading on crypto P&L. I mean, like, if you sum up all the crypto P&L made by high frequency trading in the world, it's probably like market making is probably like 5 billion a year or something, whereas just like the US equity options market, it's something like 10, 15 billion a year. US equities market is like just as big. Indian options market has blown up as well. It's probably as big as the crypto market in terms of P&Ls. They're never going to risk their ability to transact on those markets with the regulators for some DeFi crypto money. And even on crypto, like the majority of volume is still centralized, which is KYC, and they can still trade on those markets. The DeFi is still a very small piece of the pie as far as the big picture of trading goes for these big traditional market makers. So they're not going to take the risk generally.
Yeah, one other thing is that, okay, so we kind of established, well, at least from my perspective, like prediction markets are interesting and probably useful to some extent with something like elections. And then there's a lot of volume on sports right now.
Sports,
yeah. But I was playing around, so I played around with Kalshi. There's some weird things about prediction markets for sports. Like, for example, this is a little random thing, but this is what is the difference between obviously interfacing with a sports book in Vegas versus interfacing with an order book. Draws. So for example, I saw this the other day with a UFC fight. There was a no contest and it settles at 50-50. And so you could have bought somebody up to 70, 80 cents. You could have bought the favorite up to 70, 80 cents. It goes to no contest and it settles at 50-50. Well, on a sports book, they refund your full bet typically. There's a lot of weird little nuances actually with books, I think, order books that are different with prediction markets. And I'm I don't know if this is really the future.
Yeah, it's regulatory. The legal mechanism by which you would have the same outcome in a sports book, which is the correct outcome, by the way, right?
Right.
I think everyone would agree that if it's a no contest, everyone should just get their money back. The issue is because it's not a bilateral agreement between you and like the exchange. It would
right.
between you and the sportsbook. It's like an agreement between two counterparties on the other side of a futures contract. There would have to be a tear up of the contract, and then it goes back to what I said before. If you basically, this is all governed by the Commodities Exchange Act, and like tear ups are generally like not allowed to happen. So there has to be some mark price that the exchange has to settle the contract at. They can't just say the contract is null and void. And then what mark price do you use? Well, I mean, you definitely can't use 0 or 100. 50-50 sounds okay, but if you think for one millisecond, it's actually terrible. Maybe you could settle it to like some average of like, and like they all have to settle at one contract price, right? Like, so you can't just say, oh, you get it back at the same price you got it back at. There has to be some resolution price. Maybe you could do like an average of the price. So then it's like, if somebody was 70-80 favorite, you get something close to what you deserve back. But
I think
they just went to the simplest possible way.
My question though is like, okay, so then that's one thing that I've noticed with sports. I'm like, I think this is probably suboptimal, and maybe those are edge cases, but there's you still probably wouldn't want to bet into that. So like, where do you think maybe prediction markets are really useful? Like, okay, elections, what else? Because this is like the talk of, right? This is like one of the biggest narratives right now is prediction markets, and I'm not sure how are we going to have millions of Taylor Swift events a day? I don't know.
So if you study what happened with Betfair, like it was fairly, they tried to explore every avenue for this. There's another exchange called Smarkets. You can look at it in the UK. Basically, sports and elections like the only thing that have worked consistently. They've tried like pretty much every contract under the sun. They have these like, they try and do financial contracts as well, but it's just like why would you trade a yes no on with terrible liquidity and really high fees on the Fed raising rates when the CME Fed fund futures, right? There are weather futures, there are energy futures, any kind of like business risk that anyone wants to hedge that's based on some outcome that's like a continuous price. There's already futures on that, right? There's electricity futures. They're coming to the US. My friend Sam Tagle is bringing that with this new exchange called Electron X. They're already trading kind of OTC over brokers. We have them in Europe for a while. Power already exists. So it's like, firstly, it depends on what you call a prediction market and not. If you call a prediction market as in like a binary yes-no outcome of an event, that's actually a very poor way to create that kind of market where there's lots of different people playing for lots of different games. Some are hedging, some are speculating. You would rather do it through like a traditional futures contract that just settles based on some linear price deviation away from some settled price, like weather futures or whatever. If it's really yes-no stuff, historically, in the last 25 years, the only thing we've really seen work are sports and elections, and like nothing really comes to mind that's like way more interesting that should be resolved in a yes no manner, right? Like, I mean, there are people talking about doing perps on like compute power or like AI compute or like AI inference times and stuff like that. I think that's cool. That's not prediction markets.
I think like Don Wilson's super keen on this right now.
Yeah, absolutely. I mean, I think that makes sense, right? Because like there are natural buyers and sellers, there are natural speculators. But that's not a prediction market. Again, that's just like another futures contract, pretty much.
Yeah. Interesting. Okay, tell us, where can we find you? How people can, if they're allowed to, eventually engage with QFEX, and going forward, show everything you got.
Yeah, absolutely. So most active on X. You can find me. It's just at Annanay, my first name. I try and do a interesting article post once a week, and then like random shit posting, whatever. Feel free to reach out to me there. I'm like pretty responsive there. And then in terms of QFEX, we should have the waitlist back up by the time this is published. So we actually closed the waitlist. We got like 10,000 people, and we didn't want to like have like people on for like a 150-day wait time or whatever. We should have it end of this week. So that's November 14th, I guess. So if you're watching this post November the 14th, go on qfex.com, sign to a wait list. We have a referral program with very nice few rebates. And we should be live by December for the first people on the wait list, aiming to be fully live for everyone by January of 2026.
Awesome. Well, thank you so much for coming on. This has been fascinating.
Thanks for having me. And I'm so happy I finally got to go on the legendary Gwot show.
Yeah, exactly. Appreciate it.